biggest winners, some of the most explosive, in a positive way, situations were kind of these lightning in a bottle stocks. And they had kind of three primary components. Number one, they started when they were small, and so they were microcaps. Many of them were sub 100 million market caps. And the reason for that is, small, great businesses, there's a discovery process. First, retail investors discover the company first because they're the only ones that have a small enough amount of capital that can acquire the shares because these companies are so illiquid. And when you're looking at a sub $100 million company, you're in that first part of the discovery process of the great company. And so that's why being small matters. Kind of had three primary components. Number one, they started when they were small, and so they were microcaps. Many of them were sub 100 million market caps. And the reason for that is, small, great businesses, there's a discovery process. First, retail investors discover the company first because they're the only ones that have a small enough amount of capital that can acquire the shares because these companies are so illiquid. So it's smart retail finds them first, and institutions find them second, and then dumb retail buys them third, on the back end of it. And when you're looking at a sub $100 million company, you're in that first part of the discovery process of the great company. So that's why being small matters. The second part of that was a business with a high organic growth rate and or high operating leverage with the business. And the reason why that's important is pretty much anybody and everybody, including institutions, are attracted to high organic growth rates. And it's also important that they're not cash burning companies. You got to find them profitable and or very close to profitability. And the reason I like high organic growth rates as well is if you're buying them at a reasonable price, your forward return should really match the organic growth rate of the company, even if the multiple stays consistent over time. And so, you have this unique business with a high organic growth rate. And then what I kind of like the jar part of it or the bottle part of it is having few shares outstanding. The outstanding share count of the company kind of less than 20 million, preferably less than 10 million. And I'm a big fan of scarcity. And the reason why a company with a low outstanding share count is so attractive is just there's not very many shares available for anybody to even acquire, the business. And so when somebody goes to buy the shares, they have nowhere to go but up. And it's kind of similar to, I used kind of the comparison to Pablo Picasso. Pablo Picasso produced, I think, 1,900 original paintings during his lifetime. And today he's probably the most famous artist on the planet. And most of his paintings are owned by private art collectors and also museums. And only probably one or two or three come up for sale every year. And those one or two or three go for tens of millions of dollars to over $100 million in value. And that's because of scarcity. It's just a lack of supply and unlimited demand. And that's the same thing with liquid stock, a company with few shares outstanding. And even if you want to take scarcity to another level, great businesses in general, whether it's large cap or micro cap, great businesses trade at a premium because there's a scarcity value of them. There's not many of them that exist, and that's why they trade where they do. So that's also an element of scarcity that I find attractive. So when you combine all three of those things, small company, unique one-of-one business that has a high organic growth rate or a high operating leveraged business, combined with not very many shares outstanding, it creates very explosive kind of earnings per share growth. And that's what I've seen over 20 years is it's those companies that can go from zero earnings per share, $1 to $2 per share, earnings per share in 1 or 2 years. That just captivates, mesmerizes the investor base, and the institutions are just drawn to them like a moth to a flame. And that's where you get 10 baggers, 20 baggers in a couple of years is from those situations. And so that's primarily what I wrote the article on, is kind of drawing on some of my past experiences. I just wanted to talk about Benjamin Franklin and the kite experiments. I kind of threw that into it as well. Networking is probably one of the most important things that we do as humans, not only through investing in business, but also life. And kind of sticking to investing, as a stock picker matures, your edge goes from kind of only being analytical, or you have a slight difference in your strategy, and it develops into a relational edge, I feel. Your ability to get to the truth on a stock very quickly is really, really important. When you know who to go to with a certain question, whether it's one the company specifically or an industry question, that's a huge advantage, and finding the truth quickly is an advantage of building out your network. And for me, it's one of the reasons Microcap Club was started back in 2011. It was one of the two core reasons. Number one, I launched Microcap Club in 2011 to be sort of an idea generator. I wanted to see what the smartest investors in my niche of investing, which is microcaps, what they liked and why. Second, it is really kind of supercharged the ability to build out an investor network, because you can see what other people like and you can communicate with them internally on our platform. And so, just building out a network for investing purposes, can be huge. Kind of getting off the Microcap Club soapbox for a bit, you have to be proactive building that investor network. You can't just sit back and expect people to come into your line of sight and get to know you relationally. Like, you have to be proactive with it. And so, I think it's really important that's what I tell young investors too. It's like, get out there and showcase yourself, start a blog, present more, just let people see you, let people see your potential. And I'm a big believer that you really need to kind of supercharge serendipity, a little bit, and you just have to be proactive in letting people know that you exist. And even when it comes down strictly on investing, there's just like simple things that you can do, such as when you're writing on an idea and you like an idea, there's probably a bunch of other folks that like that idea well. You can search Twitter, you can search Google, and you can just form connections that way by reaching out to that individual that wrote on that idea and just getting to know them, sharing, collaborating, reciprocating. And I think over time, it goes well beyond just networking with investors. I think it's also you start networking with management teams, and you've built management team relationships over not just years, but decades. You've built relationships with experts that you've gone to get advice on different industry dynamics or strategy of some of the companies you're looking at. All these people, you hopefully had a positive past experience with. Hopefully you added value to them, so they see value in you. And the ultimate goal, I think, for any stock picker, and I think if you talk to any successful stock picker that's been investing for over a decade, they would say that their personal network of investors and their personal network of relationships is probably their greatest asset. I think probably the high point of anybody's kind of network or relationships is when you are that first call that they make. Somebody in your network reaches out to you and shows you an idea. And that's when you know you've made it. When your network pulls you into great situations because you value your involvement. And I think that's the sort of goal of anybody. Just because a company is small and the stock is illiquid doesn't mean it's undervalued. There's plenty of illiquid small microcap companies that are fairly valued or overvalued. You still have to do some valuation work. Just that here in the U.S., if I focus just on the U.S., I could still, I think, do very well, just because there's new ideas in the U.S. are mainly companies that have been around for 20 years as a small public company. A new management team takes over that business, provides a capital infusion, kind of refocuses that business on a new area, and it becomes almost like a new company. It's just in the old vehicle that was there before. So you have all these transformations that are kind of the new companies kind of here in the U.S. And that's predominantly what I'm looking at as well, is kind of like an old idea that transforms into a new idea with a new management team. And that's perfect.